Welcome back to Hong Kong and the Asia Investment Conference, where a number of the key issues of today have been under discussion, including commodity price spikes, the recent turmoil in the Middle East, and as well the crisis in Japan. All these things, of course, enough to unnerve investors. Joining us now is our Head of Research for Private Banking and Asset Management, Giles Keating. Giles, thanks very much for joining us. Tell us a little bit about all the recent developments and how they've factored into your meetings that you've been holding at the Global Economic and Strategy Group.
Yes, well, as you know, that group brings together some of our key economists and strategists from right across the bank. And obviously we have been focused on those risks, both in Japan and in Middle East, North Africa. We certainly see those as raising the temperature of risk. We don't really see them as knocking the bigger picture off course as we go through over the next year, the next 18 months. Oil prices are a bit higher. There's a bit of disruption along with obviously the human problems in Japan. But we see this as not big enough to derail that bigger view.
And so what are the underlying fundamentals then that drive the positive view for the global economy?
Well, just as we went into these crises, the global economy had enormous positive momentum. If we look at the business surveys, for example, pretty well everywhere in the developed world and in much of the emerging world standing at or very close to highs for the current cycle, in some cases at record highs. China, the one exception, a little bit of slowing there, but that's a healthy slowing. So a lot of positive momentum and a lot of very strong underlying things. For example, corporate balance sheets with some of the highest levels of cash that we've actually got data on, and the banking sector after the problems that we had during the crisis really coming back towards normality.
So earnings have been strong, but does that necessarily mean that valuations are in the right place?
We think that we did go into those crises with valuations in stock markets looking reasonably sensible. Of course, you have to look across a range of different measures. Equities, major equity markets clearly look rather good value compared to bond markets. And on various absolute measures that we look at, in some cases looking a little bit cheap, in some cases looking a little bit expensive. But I think the overall picture looking somewhere close to fair value. Now, as a result of the crisis, you've seen stock prices come down a little bit, but so far at least we think that the overall outlook for earnings hasn't really been damaged substantially, and so that also is healthy. If slightly lower prices, with the earnings picture still okay.
In other words, we can expect a re-risking again from those people that have decided to pull some money off the table on the back of some of these recent events.
We think that will happen, but probably not straight away. Of course, actually, as it were, almost in the eye of the crisis, markets having fallen very sharply, they rebounded some of the way, so we've already had something of a rebound. But we don't think we're going to kind of just instantly carry on completely with a clear up move. And of course, there'd been already some loss of momentum in stock markets in the couple of weeks before those crises really took over. So our view, and we've just recently had a meeting of our investment committee, which brings together the asset management and private bank sides of the bank. And there, the view was that there will be a nice entry point in coming weeks. And we do remain fundamentally positive, but just for the moment, we want to just watch and perhaps expect a little bit more volatility near term.
We just recently had the CEO of Rio Tinto on as well, and we've seen the price spike in commodities. Their outlook for commodity prices was still very strong. How does that factor into your outlook?
Well, obviously we believe that we are structurally in a long-term bull market for commodities as rising demand confronts rather less rapidly rising supply in most areas. But I think within the commodity world we do have to distinguish certainly the industrial metals area, which would of course have been relevant to that speaker. There we are still positive on a tactical basis. We actually think some of the agricultural prices, which have moved up rather strongly, may be taking a little bit of a pause here. And as for oil, well, after the very, very sharp rises we've seen, of course, there can be continued volatility given all the uncertainty but we think there's probably a bit of a risk premium in there, which, although it can stay in for a while, over time might tend to actually edge out of that price.
And does inflation also pose a risk?
Well, inflation is clearly an issue in emerging markets, where by and large authorities have been taking action to try to bring that down. Of course, here we are in Hong Kong, and in mainland China, we're now more than a year and a half into the tightening program. Although there can be an element of structural inflation there as real wages tend to go up, we think the current cyclical inflation pressures will probably tend to be dampened down as the year progresses. I think the thing that really worries people, though, is whether there's an inflation problem in the developed markets. And there, well, in the United States, we are only just emerging from deflation risk. So I think we're a long way from that kind of real inflation problem. If I look ahead 2 or 3 years, well, maybe that's a different matter. And of course, in Europe, we've already got rather higher inflation pressures than the US, which is why the ECB is likely to move interest rates very much sooner than the Fed in the US.
Giles, so if the ECB does move rates before the Fed, what kind of implications does that have for currency markets?
Well, I think the expectation of that has definitely been one of the factors that has supported the euro against the dollar in recent times. We think that it will continue to provide a fair amount of support for the euro against the dollar. As we move into the 140s, which we've done for the exchange rate there, we think we're at a fairly crucial level. There are some key technical resistance points ahead. If the euro is able to break through those, then it could move quite a longer way up. But of course, those resistance points may be enough to hold it back. I think that's one of the key currency issues as we move forward. Meanwhile, the yen, I have to say, we do think the yen is definitely in a process here of reaching its strongest point. It briefly touched that level of 76 during the crisis, and I think it's highly likely that will turn out to have been a real turning point, perhaps on a long-term basis, for the yen. And the other currency of great interest is the Swiss franc to many people. And there again, we think that has probably now just about passed its strongest point against the euro.
Giles, well, thanks very much for your time and for joining us here from Hong Kong in the Asia Investment Conference. That was Giles Keating giving us view on exactly the thought process that's going through at the Global Economic and Strategy Group.